which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you and your own financial condition. Position disclosure is mainly the same as yesterday, except I shorted some Tesla after hours, which I'm currently actively managing. Everything else is the same. All right. All right. So I'm going to do my best here, which is tricky sometimes, to trade an earnings report in a major company after hours while I do our afternoon meeting. So I'll do my best, but just ask on these types of trading days that you guys are a little bit patient with me. So I guess let's start with Tesla before we talk about the market. So Tesla a little bit all over the place. Really not moving too much. Seems like it might be waiting a little bit for the conference call. The Tesla numbers on the surface of things appear to be downright atrocious. There's no other way to describe it. They're awful. But the whisper numbers are supposedly significantly less than what the stated analyst numbers are. So the posted numbers here on Tesla's earnings, again, are just atrocious compared to the estimates. But those estimates, again, I haven't been updated, I don't think. So the whispered numbers are much less. So it makes sense to me a little bit that Tesla's not down 30% on this, and that it's holding it a little bit better. But the numbers are really bad to the point where while I would expect Tesla to not be down 15 to 30% on these numbers, I am surprised by how well the stock actually is holding in. It's very range bound and it's very flat here after hours. Let's take a look at the numbers. Tesla Q1 adjusted EPS 27 cents versus estimates of 43 cents. And again, these estimate numbers that I'm mentioning are a bit inflated. So take them with a little bit of a grain of salt. But a really big miss on Q1 adjusted EPS. Tesla says we'll revisit our 2025 guidance in our second quarter update. So in other words, Tesla is withdrawing some guidance that tends to be really bad for stocks. One of the things that I've been talking about as we come into this earnings season is we are expecting that a lot of companies are going to pull guidance because there's just so much uncertainty out there resulting from the tariffs. I've been saying it for weeks on end. If you are in the C-suite of an S&P 500 company and you're responsible for corporate strategy, it's impossible to do your job right now because you have no idea what your input costs are going to be. And even Tesla, which is supposedly a more made in America brand, I guess, compared to a General Motors or a Ford, they do still take in a lot of resources and parts inputs into their vehicles that come from abroad and come from China. So the big question has been, during the COVID period, we saw that when companies withdrew guidance, they actually were not very punished for it. And that was because it was such an unusual time. The question is, are companies going to be forgiven for withdrawing guidance now because of so much tariff uncertainty? And Tesla here is just one company, and we're just a few minutes after it got reported, but so far the answer appears to be yes. On to the next number here. Tesla's Q1 revenue, $19.34 billion versus estimates of $21.37 billion. Another pretty nasty miss. Tesla says it's difficult to measure the impacts of global trade policy. Tesla says actions to stabilize in medium to long term. I don't really know what that means. Sufficient liquidity to fund our product roadmap. So that should, on the surface of things, be a good headline. Tesla Q1 operating income. This number is nasty. Tesla Q1 operating income, $399 million versus estimates of $1.13 billion. That's a huge miss compared to those estimates. Again, those estimates are probably a little bit inflated. Tesla plans for new vehicles on track for start of production in the first half of 2025. Probably a decent headline. Uncertainty could impact demand in the near term. Tesla Q1 free cash flow. This is another gross number. This number hasn't been as important to them recently, but it used to be pretty important. Anyway, Tesla Q1 free cash flow $664 million versus estimates of just over $1 billion. So another miss. Tesla sees more affordable models lead to less cost reduction. That seems like not a good headline to me. I think that Tesla is supposed to be focused on their cost reduction right now. We got a couple inside fives in a row here on Tesla. Some downside weight to them. Tesla leaves out return to growth forecast from earnings report. That's another awful headline. I just covered some. Tesla leaves out return to growth forecast from earnings report. So one of my big bear thesis talking points on Tesla hasn't just been that the stock has been expensive. It's okay for stocks to be expensive if they're rapidly growing, but that the stock is expensive with no growth. I think 2024 revenue growth was 0.95%. In my opinion, you don't justify a forward PE of whatever it's at now, 120 or something, with revenue growth of 0.95%. I mean, that's terrible. And then the headline here is Tesla leaves out return to growth forecast from earnings report. That is a really damning headline. Tesla says despite tariffs, sees increasing need for energy storage. So they're trying to deflect their terrible car business onto some of their other businesses, it seems. We remain on track for pilot launch of Robotaxi in Austin by June and builds of Optimus on our Fremont pilot production line in 2025. What is Optimus? Is Optimus the robots? Is that what that is? The launch of the Robotaxis in Austin is important. My understanding is that Austin right now is a huge hub for autonomous Ubers via Waymo. I think that Waymo and Uber are having more success with robo-taxis in Austin than any other city that they've rolled out in so far. So them getting started in Austin is obviously important, but they're behind. They're behind. Tesla still sees robo-taxi volume production starting in 2026. Okay, pretty far out. Tesla planned to begin deliveries of Cybertruck later this year in Saudi Arabia. That's definitely good. Opening up in more countries. Our lithium refining and cathode production plants are on track to start production in 2025. Localized manufacturing provides advantages. Tesla approach to result in less cost reduction than expected. This is another really, really bad headline. Their approach is going to result in less cost reduction than expected. Not good. Mega factory Shanghai to be an important asset for meeting global energy storage demand during a time of uncertain cost restructure in the U.S. Okay. Yeah, so that seems to be through all the main headlines here. I think the conference call is at 5:30. I'm currently short Tesla, not super aggressive. I got decently aggressive above 240 a little bit ago onto that pop, but I've covered a lot of that. So smaller position on now that I'm managing, and we'll see how it plays out. And then the big upside headline, if it were to come in, could come in on the conference call. If Elon announces that he's leaving Doge, I think that's the most bullish headline that could come out. So maybe he says something about that in the conference call. I'm seeing Bill Kay here say, just for the radar, Musk's government role has a 130-day limit where it would need to be extended. 130 days from Trump's inauguration is May 30th. I've read chatter that he won't extend that deadline. I think worth knowing. Yeah, I agree. I don't think that deadline is going to get extended. And so the date is really worth knowing, May 30th. I don't know. I also don't know if Musk's employment period officially started on the inauguration day. Okay. Really good information there. So we'll continue to monitor this Tesla. Honestly, the most bullish thing about this Tesla is the fact that it's not down more. Because of how bad those numbers are, misses across the board. I would point to literally the most bullish thing about Tesla is that it's not down more. So, and then the flip side of that, I think if there's any upside bullish surprises on the conference call, that could also be really leading to upside on the stock, simply because, like I was saying, everything I just read, almost everything I just read, sounds so atrociously bad compared to expectations that it's like I said in the beginning. The whisper numbers I know are much worse than those estimates. So I'm not surprised to see with numbers that bad and a pull of guidance that it's not off significantly more. Sorry, I'm just trying to manage this while I talk to you guys. 43860. Okay. So I'm surprised that it's not like I'm not surprised that it's not destroyed. I am surprised that it's not trading down. It's trading pretty much exactly flat from where it closed right now as we're having this conversation. So we'll keep an eye on it. We'll see what happens with the conference call in a little bit. Brant says he is surprised it's not destroyed. Yeah, I mean, look, if it was like, to me, being down 5% on those numbers makes sense. 5 to 10% on those numbers make sense. Specifically because of what I keep saying, the whispered numbers I think were so much worse than the analyst estimates that I just read. But I would not expect it to be down, 15 to 30% off those numbers. Where if the whisper numbers were better or more in line with the estimates, then I would expect it to be down more like 15 to 30%. That's right, Liam. All right, hold on. I'm really close to stopping myself out on some of my extra stock, so and I can't put a stop out after hours because there are no such thing as a stop after hours, so I just got to watch this really closely for a moment. Sorry, just give me 1 second to really watch this. I'm looking to potentially hit out of some of my remaining stock above, like, I'm actually not supposed to say the price because I'm on YouTube stream. They don't want me saying prices like that, but a little bit above where it's currently trading. We'll just say I was actually like inside offer, where if they bid above that offer, that's where I would want to hit out of some of the remaining stock, and I'll probably keep a little bit, but the larger trade that I put on, I am now out of. The larger trade I put on, I am now out of, and sorry, 1 second. And I'm gonna keep a little bit. Alright, so let me get a couple orders in, and then we'll go to our usual kind of afternoon meeting. All right, just a couple minutes. Just give me 1 or 2 quick minutes here. I have a much smaller position on now. I hit out of the remainder of my heavier position at above 238.60, and I got no slippage on it. A 10-cent slippage on it, which is nothing for trading an earnings game after hours. It's trading pretty thick. It's also not really moving. That's probably why. But I do still have a smaller position on, and even though it's smaller, I still want to make sure that I'm managing it properly and setting myself up for success. So just give me another minute, and I am good to go. All right, that should be good enough. Okay. So let's jump in to our usual afternoon meeting here. Big day for the market. Big update for the market. SPYs closed up 2.6%. We're trading up slightly after hours, very slightly, since Tesla earnings. So SPY's up 2.6%. Wow, big update. It was even bigger than I thought. 2.5% for the Qs, 2.8% for the IWM. TLT gave us a little bit of a bounce back, so we got some relief there. And the dollar also gave us a little bit of a bounce back, so we got some relief there. Tate said it right earlier about the dollar. Normally, a little bit of a weaker dollar is actually good for stocks, but in this environment where they started to sell the dollar out of fear of the end of U.S. exceptionalism, seeing a bounce back in the dollar is actually good for stocks. So it's kind of that quick update there on how we closed. Popping over to some of the charts. So yeah, I mean, the big chatter today in the VTF was that today was like the literal opposite of yesterday. We probably got a little bit more volatility with some of these silly headlines that were coming out in the middle of the day, but for the most part, it was, especially in the beginning of the day, like the opposite of yesterday. So these type of trading sessions, I spoke about it a little bit earlier in the day when I was on the radio. These type of trading sessions for me, in a lot of ways, are the most difficult. Just because of the way that my rules are set up, I don't like to chase extension and I don't like to chase gaps. It tends to be a losing strategy to chase extension and chase gaps if your time frame is more than, if you're looking at 2-minute charts for momentum trades and you want to trade in the direction of extension and in the direction of a large gap, you can make maybe a few dollars for yourself. Doing micro scalping type of trades in that direction. That is not how I trade, because the way that I trade, I'm always really looking for bigger reward. And inherently, if you're purely micro scalping your trades, then you're not going to be getting that larger reward. That's not to say you can't make money as a trader doing that. It's just to say that that's not my personality as a trader. It's not my style. It's not my approach. I'm looking for bigger reward, ideally risk coming from 5 and 15-minute charts where I'm trading in the direction of the daily to try to capture the daily chart reward is a lot of more what I'm trying to do. So when you, like yesterday, get a really big gap down and immediately continue with downside momentum that lasts throughout the day, that's a lower probability move, one. And part of it being a lower probability move and it being not really my style, I struggle with that. And then today was the exact opposite. Today we had a really big gap up this morning, a 1% plus gap up that just immediately just took off and continued. That's a lower probability move. It's a lower probability situation, and it tends to not really be something that I'm able to overly capture outside of my swing positions. With that said, if anyone has ever seen my gap class, I talk about something called a breakaway gap. Yesterday was technically not a breakaway gap because we opened up above 520. If we opened below 520, it would have been a breakaway gap. But a breakaway gap is an example of a type of gap that doesn't get filled and tends to lead to momentum in the other direction. But one of the things I also talk about in the gap class that I have is forget for a second the names of gaps. Common gap, breakaway gap. Other traders have different names for the same gap, even if we describe the same thing. Like I know my friend Sami Abusad, he's got some different names for actually the exact same type of gap that I'll talk about, but he just has a different name for it. I actually don't remember what he calls it. But forget the names of these things for a second. And like I said, whenever it comes to technical analysis, whether it's understanding gap analysis, which is a subset of technical analysis, or understanding like chart patterns, which is a subset of technical analysis, it's not enough to just memorize names and memorize what things look like. The real key to this is understanding the supply and demand dynamic resulting from what you're actually looking at. The question you want to be asking yourself is, are people being put in the money or people being put out of the money, and therefore what are they most likely going to do next? So when you see like gap and go continuation, why does that happen? And again, it happens much less often than like the gap fill situation. Why does that happen is typically because the gap itself puts the market participants who are in the market off sides, and then they're forced to chase or to liquidate or to stop out, and that can then create the movement in the direction of the gap. So like, now circling back to names of things, a type of gap that tends to lead to a gap and go situation is what we call a breakaway gap. A breakaway gap is when you gap below a support level or above a resistance level. So yesterday is not textbook perfect because we opened up above 520. 520 is the really important support level on the daily chart that we had been noting last week. But even though we opened above 520, within 6 minutes we were below it. And then all of a sudden, if you're below 520, if you're leaning on this daily chart 520 level, which was the low from April 16th, it's the low from April 11th, and you're below it, well, if you are long, then you are out of the money, you're getting stopped out, and you're being forced to sell. That's downside pressure. And if you are a bear out there and you've been waiting for the right signal to short, and you want to short, past a support level, that's, support resistance trading 101, be long above support, be short below support, then you are also selling, which I would argue in this case, because how big the gap was, it's chasing, but all the same, the market participants that are out there into a gap down like we had yesterday, the longs are going to be more likely to sell instead of buy because we're getting past a huge support level and they're out of the money. And the shorts who want to be short this market because we're breaking lower and breaking the major support level are also going to be chasing down. And that's the reason why on a day like yesterday, you get the gap and go to the downside. It's a lower probability situation, but the dynamics of supply and demand allow that to happen in certain situations like we had yesterday. Then what happened today? Today was almost the opposite. I wouldn't necessarily characterize it as a breakaway gap to the upside above 520 because we only spent, man, I've really been wanting to answer this phone call. They're finally calling me back. I can't do it right now. It's annoying. Shit. I can't do it. I'm on two streaming devices at once. Anyway, so today technically wasn't really. I wouldn't describe today as a breakaway gap to the upside either because 520 is a big level, but we only really spent one day below it, and we didn't really establish it too much as a resistance level. But I think that enough people got pushed out of longs and into shorts yesterday that us then fully erasing yesterday between a little 1 hour rally into the close combined with a very large gap up, then just screwed over every single person that sold stock yesterday. If you sold stock yesterday as a short sale, now you're getting squeezed this morning. If you sold stock yesterday as a long sale because you're like, oh my God, we're getting below 520, the next leg of the down move is occurring, then you're either rebuying your stock, which is demand, or at a minimum, you're not on the offer selling to book profit on the way up because you already were forced to liquidate yesterday. So that's why the price action, I think, traded the way that it did both yesterday and today, where we had these more difficult kind of gap and goes in either direction. And I actually, in the morning meeting today, kind of predicted that this could happen with a decently high probability. And even as I said that in the morning meeting, I also said I wasn't chasing price because I just don't chase price. I don't violate my trading rules. And maybe you could argue that I should have an adjustment to my trading rules to account for these situations, to occasionally chase price when that happens, but it's just not really something that I do. It's not my approach. But what I said in the morning meeting today was, when I saw how big the gap was, even though we were trading below 520 when we were doing the morning meeting, I was like, watch this 520 level, because if we get above 520, what I thought was going to happen yesterday might actually happen today, but it could happen even more ferociously because of what happened yesterday. And again, what did I think was going to happen yesterday? Remember, yesterday I was dead wrong. Yesterday we gapped down to 520, which was a support level, and we did it on news that I'm not going to say isn't important. Um, News of Trump trying to potentially fire Jerome Powell is really important, and the Fed staying independent is of the utmost important in my opinion. But I felt that the news that had us gap down to that 520 yesterday was more noise than news. Where yeah, he's chattering about firing Jerome Powell, but he's not actually going to do it because, I mean, it would just destroy the market. And he should wait, just until Jerome's term at this point runs out, and then he can put someone new in place. I also did put an asterisk around my saying that because I have been wrong now a couple times on Trump's actions, as they just seem to be really, I don't know what the right word is I'm looking for without sounding overly insulting, but sporadic, random, not necessarily what's best for himself or for the people of the United States. So, maybe wouldn't overly surprise me if he truly tried to fire Jerome Powell, but I just thought that the gap down yesterday was more noise than news, and we're gapping down into support, and I thought that we would actually get bought up off of it, and I was entirely wrong. And then this morning I was like, watch if yesterday was just like an Easter Monday anomaly. Most of the world was on vacation yesterday. A lot of markets were closed. Just the U.S. market was open, and now if we can get back above 520, we might buy this market right back up and fill the gap like I thought was going to happen yesterday. But again, it could happen even more easily today because now shorts are getting squeezed. New longs have to rebuy the market, or at a minimum, those longs are not starting to book profit on the way up. And lo and behold, that's pretty much what happened. So now yesterday is looking like this Easter Monday anomaly. We're back above 520. Yesterday looks like more of a shakeout. It looks like the further building out of a wedge here of higher lows and lower highs, a wedge pattern. We can see which way that wedge eventually breaks. But we're back into the consolidation, or back above a major level, and the technicals look significantly better. And yesterday, maybe you could even argue as a lower high, but that only, a higher low, but that only would be confirmed if we actually truly break up. So more likely we'll continue to build out a tightening pattern, build out a wedge here, and then we can see which way we break. But I would say that today was very productive for bulls. The recapturing of that 520 yesterday becoming now a shakeout of support can enable this market to further continue to the upside. And I still think what I've been saying for a while is that the headline risk and the positioning risk is also still to the upside. And then, today's trading session was a little bit crazy. We had the gap and go early in the day, but then we were getting these wackadoo headlines hitting midday, none of which, in my opinion, had any substance behind them at all. But they managed to rip the market up and then rip the market down and then improve the market a little bit, even though there was no actions behind them. First we saw headlines coming out from Scott Besson that basically said, like, I don't remember what the exact language was. If anybody has it easily in hand and can copy it into the VTF, I could give you the exact quote. But basically said that, a China deal is necessary and we can't continue to do what we're doing. The market loved that. No substance behind it. No, hey, we have a phone call scheduled. Imagine if you said we have a phone call scheduled. That's one of the things I keep pointing to in our morning meetings about upside headline risk is if we say that forget about even a China deal, because you're not going to get a China deal if you don't have a phone call first. But if you even see that someone under Trump and someone under Xi are scheduling a phone call, I highly doubt it'll be Trump and Xi having the first phone call. It'll be someone who works underneath of them. But if you see that, then I think you can get a rally in this market that makes the bounce that we had around noon today look like nothing. I mean, this was a bounce that was on nothing. It was Scott Besson just saying, yeah, we don't think that the situation with China can continue. We got to come to the table at some point. And the market loved it. And then next thing you know, at a little bit after 1 o'clock, we saw a headline come out that basically also stated the obvious and had no substance behind it. And it just said, yeah, trade deals take a long time to happen. It's like, yeah, of course they do. Everybody knows that already. Trade deals tend to take a long time. And then the market got hit down hard on that. And then we saw some improving headlines, I feel like, after that helped this market rally a little bit. So we're still, very beholden to headlines. It continues to be a market where bad headlines and bad news do bring us down, but it seems like there's more upside risk to positive headlines than there is downside risk or negative headlines. And I think a lot of that is resulting from how positioning in the market is currently. It seems like everyone is hedged for the downside risk and no one is hedged for the upside risk. And on top of that, we know we now have some supportive flows coming from CTAs, which are set to buy about $5 billion worth of stock over the course of the week in a flat tape. And soon we're going to be having buybacks turned back on as well, which will also give us a little bit of a further bid. So this market should be able to return. I don't think it's going to return to normal, but it should be a little bit more normal than what we saw earlier in April, which was a market moving in a way that I've never seen in my entire trading career, to be totally honest. You have to go back to the financial crisis. I only started trading prop in 2010, so you'd have to go back into the financial crisis to really see action like what we saw earlier in April. I mean, it wasn't as long as the COVID sell-off and rebound, but it was even more hectic than a lot of aspects of it. So that's kind of where we're at on an index level for the market. It's a little bit of a gap analysis lesson in there as well. Trying to think if I had anything else to talk about from today. I thought I did, and now it's escaping me. So if it comes to me, I will bring it up, and if it doesn't, then I won't. But with that said, I'll turn it over to you guys for questions. I know some questions came in earlier while I was trading Tesla, so I will go back to those. Let me scroll up into the VTF in order to start from the beginning. I think the first thing I'm seeing is from Liam WYM. I assume that means what do you mean? I'm not up to all the letter acronyms that all the kids do these days, so sometimes you gotta just treat me like a little bit of a boomer. So assume that means what do you mean? What do you mean by whisper numbers? So the best way that I can describe it is when I'm reading off like those Tesla numbers like I just read off, or Bill or Pat posts them, you see what the number is versus expectations. But whose expectations? Whose expectations are those? And do they even matter what these people's expectations are? Those expectations tend to be like sell side estimates. It's usually like an average sell side estimate. So the thing about sell side analysts is that they don't actually move money themselves. They provide color for the people that do move money, like hedge funds. But what is a whisper number? So if the sell side analyst, let's just say the average sell side analyst for Tesla's Q1 adjusted EPS, if the estimate was 43 cents, that might be, that's a number that might be coming from JP Morgan and Wells Fargo and Bank of America. It's not the number that is coming from a major hedge fund shareholder of Tesla. And maybe a big fund out there has a really large stake in Tesla, and their actual estimates are 35 cents, not 43 cents. So their actions on Tesla are going to be based more off of their estimate, based off of what Tesla reports versus their estimate, than what Tesla reports versus the average sell-side analyst estimate. So, in some situations, and guidance is more important than the previous numbers, but just let's make it simple. Um, if the average sell side analyst estimate of Tesla is 43 cents, with the big hedge fund, their internal estimate 35 cents, and then let's say Tesla reported 38 cents. That's a miss on this average sell side analyst estimate, but it's a beat compared to the whisper number of 35 cents that's coming from the larger hedge fund and what they're going to act on. So what you will see throughout every earnings season, and this is a good reminder, I always like to put this reminder out there into every earnings season. What you will see in every earnings season occasionally is companies miss across the board and go up, or companies beat across the board and go down. Now, most of the time, does a stock will go up on its earnings report if it beats on estimates and goes down on its earnings report if it misses on estimates, most of the time. But once in a while, you see the opposite. And we're actually seeing that a little bit with Tesla right now. Tesla's numbers are bad. They missed on every single estimate. But they maybe aren't as bad as what people were internally estimating, who are the big holders of Tesla stock. So that is probably the reason why Tesla is trading very small positive right now since it reported, instead of being down 25% like you would think on the surface of things. So that is kind of what an estimate, it's kind of what a whisper number is, Liam, and I hope that helps. From Richard, yeah, no problem. From Richard, maybe everyone's still just waiting for the Q&A. Yeah, seems like it. Seems like everyone's kind of waiting for Elon to talk. From Tate, so it's like during COVID where guidance goes out the window. Kind of ridiculous how whenever the environment turns tough, these companies just throw their hands up and say it's too hard. Yeah, so you would think that hits companies because it hits the S&P, is what I would say. And that's just again, I don't have a lot of experience in dealing with market environments that are so uncertain from a macroeconomic perspective that companies can't even provide guidance. The extent of my experience is the COVID period, but what I would guess is the market is anticipating, like the S&P 500 is anticipating that a lot of companies are going to be able to report earnings, so therefore the S&P 500 itself is trading lower as a result. And then maybe you can get a little bit more of a pass from an individual stock as it doesn't provide that guidance. Maybe. Just taking a stab at it. Liam saying that Tesla has a Palantir-like multiple with J&J growth. Yeah, basically. From Christopher, just curious, this question is a little layered, but I'm trying to wrap my head around how watching the option flow that you and Pat post in the VTF, do you usually see an edge in trading something the opposite of what flow gets picked up? Like you see bearish action, do you want to be, no. Do you want to be long a position in the stock? No, the opposite. I don't like fighting option flow. You have to kind of learn to read the importance of the option flow that gets posted in the VTF. Generally speaking, it's really important information for a number of reasons. Reason number one on why it's important is large order option flow can really only be done by large money, aka smart money. So you are seeing in real time what some of the biggest players in the market are doing. And that's really cool because if you think about like hedge funds and what the positions are that they only have to disclose that once a quarter. And by the time we all see the latest updates on what, I don't know, every important hedge fund has, a lot of times it's stale by that point. When it comes to large order option flow, we might not know who the player is, but if you see someone putting on a 1 DTE SPY call where they're buying $2+ million of it, I like to think I've become a decently big trader. That ain't me. I am not putting on an out of the money, low probability 1 DTE SPY call where if I'm wrong, I'm gonna lose $2.1 million or whatever it was. No way. All right. So that is smart money. So with that said, not probably the majority of the large order option flow that gets posted, I would say it's things that you want to note it, but it's not necessarily actionable. When it becomes more important is one, if it's particularly large and unusual, like we saw yesterday. And that's why when Pat saw the 0 DTE and 1 DTE SPY calls that went off at like 3 p.m. and 3:30 p.m. respectively, we both were like, holy cow, do you see that? And I remember Richard was asking questions about it in real time, and I was saying like, yeah, it's a low probability call option that they're putting on. It's like a lotto. But we've seen in the past that those super sizable, like random, almost seeming, impossible seeming end of day option flow when it comes in on size actually seems like it hits pretty often. Because there's some real smart money behind doing that. And the person that put on that 0 DTE call option, the smaller one, it still wasn't small. It was like $90,000 at 3 o'clock. That only had a 1 hour till expiration and was like $3 out of the money. It's still a big money bet on that. And then 30 minutes later, we saw the even bigger one that was expiring today. That was those 514 calls. That might have seemed crazy when they were even coming on. So that's smart, big money that's doing it. So that's one. Two is option flow of that size has very large market impact. And that, in some ways, is even more important. It's got very large market impact. If you remember back in like the COVID period of time when actually Tesla was one of the bigger culprits of this, Tesla was going crazy, it was going through the roof. A lot of people started talking about the concept of like a gamma squeeze for the first time. And this is just a result of market impact, right? So options are inherently levered bets. And an option is a naturally levered derivative of a stock, right? So when you see like that huge SPY call come on yesterday, the $2.1 million 0 DTE call that hit with the 514 strike that at the time was out of the money, who's taking the opposite side of that trade? That trade can't go off. You can't buy those calls if there wasn't someone that was there to sell them, right? Well, the person that's there to sell them is most likely a market maker. But the thing about the market maker is that market maker doesn't want risk. The market maker they're just trying to make money from spreads. They don't want risk. So the market maker that had to sell those calls to that large buyer, what they immediately are doing is they are buying SPY. Like the second they fill that order by selling those calls, they're not trying to be naked $2 million worth of calls. They are immediately buying SPY equity to hedge out the calls that they just sold, to try to make it so that they're market neutral on the bet. They're not trying to take a bet on if the market's going to go up or down. Like I just said, that's not what they're doing to make money. So then what's the market impact on that is they have to buy, a little beyond my math skill to fully tell you how much they needed to buy. But in order to hedge that, they needed to be able to buy enough to offset being short $2.1 million worth of calls by buying the underlying equity. So it almost becomes like a self-fulfilling prophecy. So pay attention to all of the large order option flow that gets posted in the virtual trading floor because it is all important, not necessarily all actionable, but something you want to pay attention to. But the stuff that I find to be really important is either stuff that's very unusual, like we saw yesterday afternoon, or stuff that's repeat, stuff that's consistent. Like back again in that COVID period when I was just mentioning Tesla, the thing about like that Tesla, or there's a lot of GameStop, a lot of other things that created these insane moves higher and insane squeezes, was that there was just non-stop call flow hitting. It was just one after the next, after the next, after the next. And again, that is constantly having to be hedged out by the market makers on the other side of that. So you're just seeing these insane squeezes higher. So I pay attention really to repeat flow, and I pay attention to really unusual flow. And if I see either of that, I ideally at a minimum do not want to be on the other side of that trade. So like what you were asking me here of if you see bearish action, do you want to be long the stock? No, it's the complete opposite. If I am seeing consistent bearish action, the worst thing I want to be is long the stock. If I'm seeing consistent bullish action or very unusual bullish action, like what we saw with the spies, I don't want to fight the flow. Don't fight the flow. Go with the flow. Again, if it's a one-off here or there, it doesn't necessarily matter. You know, Pat has to post the one-offs too, even if they don't necessarily matter as much, because we're not going to know if it's repeat flow if we don't see the first one go off and the second one go off and then the third one go off and then the 30th one go off. But I am very, very uncomfortable when I'm fighting unusual option flow in the market. I don't like to do that. So I hope that helps, Christopher. I appreciate the question. From Pete, general question: what percentage of your trading would you say you do pre-post market? Do you typically do most within regular trading session? Yeah, I do the vast majority of my trading during the regular trading session. I don't know what the percentage is, but I do the vast majority of my trading during regular trading session. I don't know, 95%. Once in a while, I'll trade an earnings report after hours, like I just did with Tesla. When I wake up to a really big gap and I have swing positions on, I manage the swing positions to the price in which the stock is trading. But beyond that, I don't do very much pre and post market trading. There's no limit down. From TT, where do you like to route orders after hours? I usually use NASDAQ, which is what I usually use during hours also. You can use ARCA. ARCA's pretty good too. You know, there's no stops after hours, right? So you have to be skilled enough and knowledgeable enough to be able to cross the market to liquidate a position, like what I did with Tesla when I was short some Tesla, and I said I wanted to get out of the remainder of my larger position in Tesla at above 238.60. What I did was I crossed a bid for the amount of stock that I wanted to buy if it got above 238.60, because I can't use a stop. I can't just have a stop at 238.61, which is what I would do potentially during market hours. So I'm taking a bid and I crossed it all the way up to like 240.50 to account for slippage of a fast movement or something like that. And then the second I saw a print above 238.60, I immediately hit out. And I remarked that I only got 10 cents of slippage, which is nothing for after hours trading. It's absolutely nothing. Yeah, last 2 days in a row we've had these gaps that haven't given us an opening test yet. I think we went over in detail kind of the mechanics behind that. From Tate, do we have a game plan for when the IWM and QQQ strength flips about an hour or so after the open? We've probably seen this over 100 times in the past 2 years. One index, either the IWM or the Qs lead early, and then we get a clean flip once relative strength is established. Today was a perfect example. The IWM led pre-market and then flipped to the Qs off the open and later flipped back to the IWM into the close. The kind of action makes it rough to nail directional conviction, especially when we're moving lower and everything starts correlating on the way down. I get that this is the classic dispersion trade on the way up. That's how markets work, right? Things flip intraday. Just wondering if there's a playbook for how to handle these shifts, and if not, what's a good starting point to build one? Sure, it's a really, really good educated question that I don't have a great answer for. The reason why I think I don't have a great answer for it is because I don't think that the answer is consistent. I can give you an analogy. So we've spent a lot of time in the past talking about how the TLT's correlation to the SPY and Qs and IWM changes over time based on the market narrative, right? Where sometimes lower bonds moving up, which means lower interest rates, is good because companies can refinance better and it's bullish for the stock market. And other times, TLT moving higher and bonds moving down is bad because it represents a fear trade and it's a negative for the market. I think with what you're describing here, with like the flipping of relative strength between the IWM and the Qs and who the leader is and what you want to read from that really depends actually on the environment that you're trading and the other factors, like similar but different to what I just described with TLT and interest rates. So it makes it hard to build like a real playbook out on what to do in those situations. Like recently, we had noted that the IWM had been a leader. That's been the recent narrative. So I could tell you for myself, I got pretty concerned about this rally when the IWM topped out at 945 and showed relative weakness into this 15-minute correction. I got worried that that was a signal that the SPYs and Qs were going to struggle to continue. That concern turned out to not play out at all. But it was still a concern for me because I think you've noted as well, Tate, recently IWM has been a leader even on a 5-minute chart. And then today, again, all of a sudden it wasn't. So I wish I had a better answer for you on a game plan and a playbook that we can build out for these shifts. I don't. Sometimes it's just a matter of like the way bull markets work. I think is what you're describing a little bit. Is constant rotation. Like a really, really good bull market is you get leadership from whoever, Qs, IWM, whatever. It extends and then it pauses, and then the laggard, the IWM or Qs, catches up to what went first, and then that rests, and then they kind of flip back and forth. So we see that a lot in a bull market, but yeah, I just don't think that it's consistent enough to be able to build out a specific game planning playbook. But obviously, let me know if you see or think differently. From Zahora, where is the SEC on this flash news from the White House? Aren't these market manipulative driven news subject to investigation by the SEC? I don't have a good answer for you on that one. I don't know the rules around that. I can tell you that insider trading is allowed in politics, which is a huge pet peeve of mine. We talked about it a little bit even pre-market this morning. Why is it that if I were to insider trade as a professional trader especially, I could get like 20 years of jail time, but politicians on both sides of the aisle do it consistently all the time, all day. And I'm sure every president probably engages in it in some degree or another. I remember noting, personal opinion, I remember noting the last time Trump was president, and I'm noting it again that this time when Trump is president, that it seems to be like more often and more in your face than at any other time. But I don't think it's illegal. And I am a big advocate, and this is not a market take necessarily, so I'll be careful with it, but I think that it's something that just about every normal person agrees with. I'm a big advocate that we need to change the rules so that people who are in Congress, in the Senate, in the White House, the President of the United States, the Vice President of the United States, can only own index funds, not individual stocks, and not crypto. Not crypto. Who knows who's buying Trump coin? Who knows who's buying Trump coin? No one knows who's buying Trump coin. It's on the blockchain. There's no, you know, at least if someone buys the stock, we can see who bought the stock. When people buy crypto, you don't even know who's buying crypto. I'm not saying that this is happening. I'm not making this as an accusation. I'm just saying something that could happen would be, hey, my country really wants to be first in line to get a trade deal done with the United States. How about I make a little $500 million investment in Trump coin, and you can put me ahead of the line. There's no way we can know if that happens or not. There's no way we can regulate that or not. But if we just make it so that, like everyone else, politicians can't trade on insider information. They can't, they made it so that the people in the Federal Reserve can't own individual stocks. Make it for everyone in Congress. Make it for everyone in Senate. Republicans, Democrats, Independents, everybody, and stop this nonsense. But it's not illegal. They are allowed to insider trade, and here's the problem. In order for it to become illegal, you need the lawmakers to make it illegal. Why are the lawmakers who are making millions of dollars by doing this going to make it illegal? They're just not. It's just not going to happen. It's just not going to happen unless, I don't know, there's a real revolution and you get, I don't know, a non-politician in the White House that actually wants to change the country for good. But anyway, I digress. From Eli, so moving forward, have you taken off most of your size on longs considering we tested? No, I'm still pretty long. I'm taking some off on the way up, but I'm still pretty long. I was getting closer to market neutral with my portfolio at 550. All I've done as we've moved lower is get more long, and then one day of a bounce got me a little bit less long, but I'm still pretty long right now. What should we look to do moving forward with the charts looking like this is kind of what I'm getting at? I'm short-term bullish and long-term bearish has been my thought process for a while, and that's part of the reason why I was like, I don't know, not happy about yesterday's price action, because I was wrong, one, and when I'm wrong, I tend to lose money, which I did. It wasn't too bad yesterday, though. I could have lost a lot more, and I really, it wasn't too bad. I made today well more than double what I lost yesterday, so that's good. But no, I mean, the market technicals here are not super bullish, but yesterday was a false breakout to the breakdown, right? And when you get a false move in one direction, a lot of times that can lead to a big move in the other direction. You combine that with the positioning information. You combine that with the headline risk. I would rather be long than short this market. It's a little bit hectic because headlines move us and change us moment by moment. But I like the bull side of the market if you can find the right setups for it. From Tate, what if that's just a market maker just hedging? Still a possibility. I'm not sure what that question was related to at this point. Yeah, no, I'm not sure. But if you're referring to like the SPY calls from yesterday, those large opening orders, that tends to not, I don't think that that's likely to be like a hedging trade from a market maker. No problem, Richard. No problem, Chris. From Richard, this noon, when we saw that huge put position on the SPY, I had a long SPY position. I ignored the put information, and shortly after the headline about need time to make a deal, it hit. Yeah, I don't know that. That circles back, I think, to what we were just talking about before about the insider trading and also about the option flow. I think I was either off the desk or on the phone when that hit, so I actually didn't even see that one. From Liam, when Webull was ripping 100%, you said to stay away due to the low float. What is the float range where you become more comfortable trading a stock? Do you use any screeners for stocks breaking up, or mainly just look at key names? I don't necessarily have like hard numbers on a float where I'm like, this is too big, this is too small, this is too dangerous. It's more just like a relative range. But, if I see something's got a float of less than like 10 million shares, that tends to be something I don't want to be shorting into a squeeze, because it can just get so far removed from fundamentals because of the low flow, like it becomes really scary. Where is the float number where I feel more comfortable? Again, it's kind of a floating scale. See what I did there? But above 100 million shares, I'll tend to be like, okay, you know, there's only so far that this thing can get away from reality with a float of that size, and I could feel a little bit more comfortable shorting it. But it depends on the situation. It depends on the price of the stock. It depends on the spread. It depends on if it was a recent IPO. So there's a lot of different factors you got to think about with that. I don't really use any screeners. I really only use the VTF and look at my kind of usual suspects. But I look at every single stock that gets posted in the VTF, whether it's posted by a trader because it's an idea that they have, or whether it had news that day or earnings that day. I tend to look at every single name that gets posted every single day. And in earnings season, I tend to look at a lot of stocks I don't normally look at. I don't necessarily rush to trade them, but I tend to look at a lot of stocks I don't normally look at, just because they're in play. They're reporting earnings. Tesla with a little bit of a pop back to 240 here. I understand the dynamic of not wanting to get involved in a low float stock due to low liquidity, but what is the level of float where is just immediate no trade rule? I'm not going to say that necessarily for any stock with an immediate no trade rule, but I will say, below 10 million shares, I'm like probably not looking to short it. I have another question about how you allocate capital to swings. I know you talked about never risking more than 5% a day in day trades, but what are you doing with leftover capital? What percentage stays on the sidelines, and what do you allocate to swings and intraday? So the way that I'm going to answer this is by not telling you what I do, but telling you what I think is the right thing to do. So I think the right thing to do when it comes to swing trades, which I've discussed in the past, is to only swing positions when you are already in the money on those positions. So if you're already in the money on the position, you're more or less in a win-win situation. Let's say the next day you're long the stock, you booked a little bit of profit already, you're in the money on the position, bad news comes out, or whatever, maybe the whole market cap's down, and you end up getting stopped out of the position. All that happened was you gave back money that was open P&L. So hopefully, unless it was really, really bad news that randomly happened to happen overnight, which can happen, it's a danger of swinging, but is really pretty rare. Hopefully the worst case scenario is that you if you were super greedy, you end up break even on the trade. Hopefully, even if you're getting stopped out, you make money on the trade because it worked enough for you to swing it to begin with. And that's where my 1% or 2% rule comes into play, where you want to be at least 1 or 2% in the money, and for some stocks probably even more than that in order to swing it. And then if you happen to get good news, then great, you're continuing to get paid even more. Or the market continues, great, you happen to get paid even more. So you're like in a win-win situation. Where I don't like people swinging positions is when they're swinging it because the position closed against them, because they're hoping it comes back. That's a lose-lose. You are risking now unlimited money because who knows what's going to happen with the gap overnight, in order just to try to make your money back to get to zero. That is very bad risk reward. You're not going to make money doing that. So why am I reviewing that? Because it circles back to your question. If I, let's just say, risk 5% of my account per day in my trades, and I have a swing position on that is from yesterday, that's in the money, I'm not concerned about that, right? That is based off of yesterday's trade. It's already in the money. I am still going to allocate that 5% that I allocate per day to my day trades to my new day. Now, let's put some real numbers behind that. What could happen is, let's say your maximum loss is supposed to be $500. Maybe today's a really bad day and you end up down $700 because you gave back $200 of open P&L from yesterday, which again, It's not the end of the world because it was open profit. You're not losing money on that. You're just giving back some profit. And every trade you took today failed, and you lost your $500. So you should never really lose more than 500 a day. But today you're closing down 700. I'm okay with that because you followed your risk rules. You did not let yourself lose more than the $500 daily limit that you give yourself. And the extra bit was, separated because it's from yesterday, and that's swing P&L that was actually in the money and is not truly a loss, even if your trading software is showing you down that extra $200 on the day. So I hope that helps. Good question. From Liam, also would like to hear your opinion about risk mitigation, about a risk mitigation strategy for starting out, assuming a $500 maximum loss. Is the whole market just popping right now on the Trump headline stuff? No, it's all good. This is how we all get better. Sorry, I just got filled in some offers in some of my swing positions. Okay. Tesla popping here a little bit. Tesla also has a good read-through potentially from some of these China commentary, but I'm going to try to hold off on reading that until I get through your question. All right. All right. Assuming $500 max loss per day, which is 0.25% of your account per day. I actually like a number a little bit bigger than 0.25%, but if you're brand new, maybe that's fine. Do you recommend starting out with at least 200 shares per trade so that you can implement proper trailing strategies versus trading with 100 shares and letting it ride? I just got filled on more offers. So the share size is calculated last. That's the last part of the equation, is the share size. The way that you should be calculating your trades is how much money do I want to risk in the trade? God damn it! I'm just getting so distracted between my phone blowing up and all these stocks moving at the same time here. It's just a little hard to focus. Tesla making after-hours highs. So the equation is, first you figure out how many dollars you want to risk on the trade. Then you figure out how much space you need to give it. Space risk is what I call that. That's the difference between your entry price and your stop loss. And then you back into the math on how many shares that you take. So the first thing you say to yourself is, all right, on this trade I'm planning on risking $100. And then the second thing is, that's it. Yeah, Trump, no intention of firing Powell. Oh my God. All right. So the example is, I want to risk $100 on this trade. I want to risk $100 on the trade. The trade is 10 cents risk. Like where the proper stop loss is from where I can buy right now is 10 cents risk. You take 1,000 shares. It's 25 cents risk. God damn it. It's 25 cents risk. You take 400 shares. It is 50 cents risk. You take 200 shares. It's $1 risk. You take 100 shares. That's where you come up with the math on how much tier size you're supposed to have on the trade. Ideally, I agree with you. You probably don't want to take trades where you can't take at least 200 shares, because if you've got less than 200 shares, you have what we used to call the curse of 100 shares. You just don't have any game planning ability. No game planning ability hurts you. So it might be worth it to say, hey, if this trade requires a full $1 worth of risk and I can only allocate $100 worth of risk towards a trade, I shouldn't take the trade at all because I can only take 100 shares in it, and then because I can't trade odd lots, I'm just going to pass on the trade entirely because it doesn't make sense for me to be involved in it. Yeah, so I think that answers your question. All right, Trump doing fine with China, almost every country. You don't even have a phone call scheduled, buddy. Wow, a lot of things are ripping here. Tesla coming back down. This is a transition period. It'll be a little while. From Trump, if they don't make a deal, we'll SE the deal? What does that mean? We'll set the deal, huh? If they don't make a deal, we'll set the deal? Okay. China will be very happy. It's at 145%. They won't be near that number. Okay. Trump says, I have no intention of firing Powell. That's the best headline within all of this. I think I got through everything now in the VTF. We got a lot of stuff over here in the YouTube. We're gonna probably try to do more quicker answers. Given all the bad news on Tesla has been priced in over the last couple months, evidenced by lack of a move on bad earnings, do you think Tesla has officially bottomed and time to go long? So it's a great, I talk about it all the time, a great signal to go the other way when a stock or market can't go down on bad news. I just don't know the degree to which this was priced in because I don't know what these whisper numbers look like. I'm surprised it's not, I wouldn't expect it to be down massive on those numbers, but I would expect it to be down, and it's not. So yeah, I mean it's a real positive for the stock that it's able to trade up on terrible news. Whether it's bottomed or not, I don't know. Probably depends a little bit on the market also, but for the short term here, it looks okay. This mirrors how the stock was moving during 2024 with the big up moves later during the year. Okay, good to know. From AR, I recognize the upward trending day around 9:45 a.m. I find it hard remaining patient with no pullbacks. Yeah, me too. Do you have any advice on these trending days without chasing? I don't. Even watching this on a 1 minute was tough. Yeah, I don't look at 1 minutes. Yeah, I don't. It's like I was saying throughout most of the meeting today. I don't do well in those types of moves like we had yesterday morning and this morning because I don't like to chase. It's a lower probability situation. I don't think that you want to be changing your entire approach to markets because of these one-off situations that are occurring. Has the conference call even started yet with Musk, or are we just moving entirely on China right now? Tesla's starting right now. Gabriel says croissant guy in an interview said that today options are the underlying instead of the derivative. I like that thought process. It's pretty true in a lot of ways. From Lev, good afternoon. Please tell me, I already wrote, but is there still a possibility of a summer internship in the company? I don't think that there is. Sorry, Lev. But keep following along. And I apologize if you emailed me and I didn't respond. My inbox has been about as hectic as the market lately. For Mr. Trees, AMD here still going. It's like this afternoon meeting has become so tough. If the options are further dated, does the market maker have more time to hedge, or do they immediately hedge no matter what the expiry date? Yeah, it's a great question. So, they have to hedge based on basically all the Greeks that are going to influence the risk of the trade. So that includes how far out of the money it is, it includes the volatility, it includes the time. So a longer dated option position that hits is probably not going to have as much of a immediate impact as a shorter dated one. From Mattia, how much do you think is the right amount of risk per day percentage wise? It's very much a personal question, Mattia. So I can't really answer that. I don't know you, so it's something you want to assess for yourself. For most people who are prop traders, I typically say no more than 3 to 5% of their account in a day. Probably 3% is a good number. But definitely depends a little bit on the individual, the account size, your goals, and all that stuff. All right, I got to end this meeting. It went really long today, which is great. I love long meetings. You guys had some awesome educated questions today that I hope everyone was able to learn from. But the market's moving insanely right now. I'm trading an earnings name. We're moving on market-wide headlines. And this afternoon meeting is becoming a little bit expensive. So I'm going to end it. Have a good night.